Well, hi, this is for my clients, and we have a really important topic to talk about today. It has to do with asset protection and cash value life insurance. And all of my clients, as you know, I'm sending this to you because you do have cash value life insurance. And there's this issue about asset protection. So I'm really honored and privileged to have Brad Barth here. He's an attorney, and he's an expert, world renowned. He's known throughout the nation, and he gives speeches all over about asset protection. And he teaches other attorneys, and is just a wonderful guy. It's a privilege and an honor to have him here. And so I'm gonna turn it over to Brad and mainly just talk about asset protection, cash value life insurance, and a little bit specifically also on California, like California dollar limits, how much they're protected if they don't use your strategies, and how much are they protected if they do, those types of things. So take it away, Brad.
Sure. First of all, Gary, thank you very much for the opportunity to speak to your clients and also for those very warm introductory comments. So basically, I'll kind of give you what you asked for, the 101 on asset protection, and then specifically how it deals with insurances and with the cash value life insurance component of that. So generally speaking, asset protection really is all about trying to position your assets in a way in which keeps them 1 degree separated from the claims of third-party creditors. So basically, everybody has assets, and those assets can be residences, residentials, businesses, corporations, partnerships, stocks, bonds, cash, brokerage accounts, insurance policies, cash values associated with insurance. And every asset that you have, because you own it, is subject to the claims or subject to satisfaction of a personal liability. So as asset protection attorneys, what our primary goal is to position those assets in such a way that if you yourself have a liability, and you can just make up the facts that present that liability, whether it's a car accident, a rental property accident, in a community property state here in California, something that your spouse does, something your kids do, something that the dog does, business related, employee related. Like I said, make up the facts. You can read it in the newspaper every single day. I don't need to make it up here. But if you have a personal liability, now the question is, and you get a claim against you, how protective are the assets? To what extent can a creditor reach and grab those assets? So where we play primarily is not so much, this is asset protection in general, is not so much on the liability phase, because remember, there's 2 phases of litigation. You have the question of, did you do something? Was there an accident? Was there a liability? Was there negligence? Right. That's called the liability phase. But now the question is, if you're liable or there's a settlement and now they're coming, the question is now in the collection phase, to what extent are your assets available to satisfy those judgments? And that's where we play. That's where the strength of our planning comes in. It's about asset protection. And what's the primary goal, Gary? The primary goal here is to get the client in a position for a fast and favorable settlement with their clients. To me, that's the definition of asset protection. To position your assets to give you leverage to negotiate a fast and favorable settlement. It's not about you don't pay creditors. It's not about throwing care to the wind. It's about, if you have a liability, and how do you get out of this thing as quickly and as painlessly as possible. You may come out of pocket, but you're probably going to come out of pocket a lot less as a result of the planning than you would have been without the planning. Okay, so really what this is a grand settlement tool. And the more, depending upon the client's overall makeup, again, the plans vary accordingly. It can be something as simple as a basic LLC or something more comprehensive involving multiple trusts and multiple jurisdictions, domestic, international. We have all these tools in our tool belt.
So there's different rules in different states.
Yes, and all that comes into play. That's right.
So just real quick, very specifically, in California, what are the limits? Like, if I own a home and I don't have any asset protection, how much could a creditor get? How much do I get to keep? And a cash value life insurance. Do you know those numbers? Yeah,
sure. Yeah. So basically, what happens here in California, what you're referring to is called the homestead. It's called a homestead exemption. And every state is different, right? And one of the benefits of being a national speaker is I get to go to different states and I get to look at their homesteads, and I can tell you that California, not so great, compared to some other states. And so considering our property values, you'd think they'd be higher. But typically, if you're a single individual and you have a homestead, now the homestead only applies to your primary residence. You can have multiple residences, right? You can have a residence here, a residence somewhere else, but only the primary residence. If you're single, it's $75,000.
Wow.
If you're married under the age of 65 and not disabled, it's $100,000.
Okay.
If you're over the age 65 or you have a disabled dependent in the house, then it's $175,000. And so what that
all of
means,
those are ridiculously low.
yeah, like I said, considering the numbers, they are ridiculous. But what homestead is, again, for your listeners here, is that a homestead is the amount of money that they are guaranteed to get back of the equity, regardless of, let's say, a judicial foreclosure. So a lot of us think like, hey, let's pay off the house, right? So you got this giant equity corridor.
They already have, $1 million or $2 million of equity.
And so at the end of that, the sheriff comes in, sells the house, gives you a check if you're married for $100,000, and the remaining 1.9 million in your $2 million example goes to the creditor.
Right.
So what's weird about it in our world, unlike in a financial world, as a financial planning world, it's like pay down your mortgage, a 15-year mortgage.
Yeah, exactly.
In my world, it's like, no, keep your property encumbered as much as possible because debt works to your advantage, right?
Yeah. And then what about cash value life insurance? Does it have, what are the limits there roughly?
Yeah, now this one, I should know this. I believe it's around $12,500. I think it's somewhere around $13,000 or less.
Yeah.
And here again, I got the exact same issues, and this is kind of where our conversation is going to go, I'm sure, at this point. Because I have many clients who they do exchanges. I remember this was very popular back before the real estate boom in 2006, 2007, way back before we had that problem. People were just pulling money out of their properties and putting them into a large cash value life insurance. And I'm sure you and your clients are aware that putting money into a life insurance policy is awesome because you get basically tax-free growth. It's like one of the last tax haven in the Internal Revenue Code, right? You actually can grow assets without paying taxes. You can take low interest loans against that policy as a quasi-retirement plan. It blossoms with a death benefit when you pass away. I mean, it's an unbelievable product.
Right.
But the problem is that when you're taking all this money out and chunking it inside a life insurance policy, well, it only has protections to $13,000. Because what people don't understand is that any type of life insurance policy, variable, whole life, whatever, is basically an insurance policy with a bank account attached to it, right? A special bank account, the magic bank account. But that bank account is what they get. That's where the cash value is, and that's at risk.
Right.
So part of what we do as asset protection planners, as well as estate planners, is make sure we protect that cash value as part of our client's overall financial and estate plan.
There it is. And that's what I really want to drill into is because right now, almost all of my clients are the personal owners. It says, who's the owner of the policy, and, essentially the insured. And so maybe, the husband is the owner of his policy or the wife is the owner of hers. Right. And so right now, all of those clients, they're exposed. Right. Judgment against them. Well, they get to keep 13,000-ish of their cash value. But I hate to say it, that's usually the first payment.
Yeah, no kidding. So let's go back, Gary, if you don't mind, and I've been throwing this. What is this tool that we're talking about? Basically, the tool that we're talking about is we refer to it in the vernacular as an ILIT, which stands for an irrevocable life insurance trust. And I'm sure if you may have counseled your clients on this, but I'm sure many people are aware that is that life insurance. And actually, let me take a step back. Many people aren't aware that life insurance death benefits are tax inclusive in the estate. Now, what I mean by that is if you have a $10 million death benefit on a life insurance policy, that $10 million is included in the owner's estate calculation for determining the estate taxes. Right. And I say that to people like, whoa, wait a second. I thought insurance was tax-free. Yeah. It's tax-free to the beneficiary, right? But it's included in the owner's estate because they retain an incidence of ownership over that asset. And anything that you retain an instance of ownership on or in is included in the estate. So wonderful. Now understand that life insurance is a unique type of product, and there's a lot of public policy reasons why it's good to have. And as we just talked about some of the initial tax benefits as far as the growth of the income tax benefits, this is because from a public policy point of view, the government wants people to be able to take care of their family if the breadwinner passes away. Basically, you die too soon, right? So this way, either the surviving spouse has wealth replacement, the children have ways of having maintenance and welfare and education taken care of for them. Because if someone passes away, which is the breadwinner of the family, and they don't have any insurance, now they become a ward of the state. They become subject to the government, and the government doesn't want that. That's why they encourage us with all these tax benefits, and even in premium ways of organizing premiums, tax benefits, to have an insurance policy. However, the challenge here is that they're encouraging us to have an insurance policy, but yet at the same time, they're saying, well, when you die, I'm going to take 40% of it, right? Because it's included in your estate.
Right.
So there's a solution to that, so that it's not only is it income tax free to the beneficiaries, but it's also estate tax free. So we have to get it out of the client's estate. I said just a few moments ago that anything that any incident of ownership that a client has is included in the estate. And as you said, your clients, it's in their name. That's an incidence of ownership. So what we have to do is we have to change the owner to a very special type of trust. And it's called a life insurance trust. And you asked a very simple question. What's the one asset that you put inside a life insurance trust? Well, it's a life insurance policy, right? It's very narrowly tailored by the IRS and the Treasury Department so that we can take these death benefits, take them out of your estate, you get them out of your name, and now not only is it income tax free, but it's also estate tax free.
Right.
And it's because of this change in ownership, Gary, that's where the asset protection comes. Because as I said a couple of moments ago in the asset protection introduction, that if you own it, the creditor can take it away from you. But if you take that life insurance policy with its underlying cash value and you transfer it to an irrevocable life insurance trust, you effectively given it away. You don't own it. You don't retain any ownership interest. Therefore, when your creditor sues you, you don't own that policy, nor its cash value. And as a consequence of that transaction, now that policy is asset protected, including the underlying cash value. So we estate planners can use a life insurance trust as an asset protection tool.
There you go. Yep. And does a generic living trust, does that provide the protection for asset protection that most people, because many of my clients, they have a living trust.
Right.
So they put their life insurance policy in that, will that work?
Yeah, now this, and I get a lot of I'm glad you're bringing this up because I get a lot of the same pushback as an asset protection planner. Say, oh, Brad, everything's in my trust. I don't have to worry about asset protection. So, okay, let's run through a very simple exercise together, Gary. And this one, it will make it crystal clear. We just got done talking a couple of moments ago about the fact that you own it is what makes it subject to your creditors attach, right? So now let's go through the exercise of a regular estate planning trust. And I normally go through, hey, client, do you have a trust? Yeah. Who's the trust maker? Who settled the trust? Oh, my wife and I. Okay. Who's the trustee of the trust? Oh, it's my wife and I. Who retains the power to revoke and modify and amend the trust? Oh, my wife and I. Who's the lifetime beneficiary of this trust? Oh, it's my wife and myself. Oh, and who has the power to put assets in the trust? Oh, my wife and I. And who has the power to take assets out? My wife and I. In other words, with a regular estate planning trust, you exercise so much dominion and control over those underlying assets that it's not an asset protection tool. It is not a separate entity.
Got it.
Which is very different than these other types of trusts that are irrevocable by definition. They typically have a bifurcation. You may be the trust maker, but you may not be the trustee. So you have a difference in ownership, you have difference in control, it's irrevocable, it has its own EIN, not your social. All of these things make it necessarily distinguished from you, so it's outside your taxable estate. So it's completely different than a regular revocable living trust. So thank you for bringing that up because it's a common misconception.
Wonderful. Wow, it sounds like there's a lot of picky little details that you set up a trust. and you get one little detail wrong, and boom, a creditor or predator could attach that money or that cash by insurance.
Yeah, and I'll make one more point, because this is one of the things that I wanted to make sure that you and I had a chance to express to you, and I'm sure you're aware of this, but maybe those that are watching or listening may not be aware of this. And again, I've been doing this type of work for 21 years, and so I've kind of seen a lot, not only from planning, from an administration, and from an estate, and from an estate litigation area. So one of the things I want to bring up in this particular space when it comes to insurance trusts is that they have certain formalities that need to be respected. Okay, so unlike the family trust that you just mentioned, you can just set it up, transfer the asset, and it's a one and done, right? You can basically set it and forget it.
Forget about it, yeah.
Right. That's not the case when it comes to a life insurance trust. There are certain procedures that have to be followed in order for this trust to be respected in hindsight when you pass away, when the IRS is now scrutinizing this transaction. Right. Are these funds truly outside the estate, or are they really just inside your estate? And what I do is I give people a very common analogy, which they're very familiar with. A lot of people are familiar with corporate formalities and corporations. So if you get sued, everyone's familiar. You pierced the corporate veil. If you pierced the corporate veil because you didn't keep up your minutes, you didn't keep a checking account, you didn't file your taxes as an alter ego. So there is no corporation because you didn't keep up with the formalities. You understand that. And so by analogy, we have the exact same thing in an ILIT. You don't own it. It has its own EIN. You have to have a bank account. You have to have funds put inside the bank account. The funds have to sit there and mature for a little bit of time before the trustee then makes the premium payments. We want to make sure the policy is going to perform as advertised. There may be some tax returns, 1041s that may have to be applied if there's some income being generated inside this trust.
Right.
There may be some initial gift tax consequences. And for those clients that have large cash values, putting something inside that initial trust, that initial transfer, it's a gift. You're gifting it into the insurance trust. And depending upon the size of the underlying cash value, there may be some gift tax forms that have to be filed. And so, in other words, when the IRS comes back and looks at this $10 million policy and says, hey, I got $4 million of potential taxes if I can find a way to include this in the estate, they're going to scrutinize all these things. And if you aren't following these particular formalities and these technical as you said, these technical formalities, then the IRS has a way in to get those monies back, and the trust fails from an estate planning point of view. So my office, and that is me specifically.
Yeah, or the same analogy is for like a creditor or a predator. If, you're in a car accident, they're going to do the same thing. They try to find one hole to pierce the veil, the corporate veil, as you mentioned. Yeah,
that's right.
And
so just
follow your rules. You'll be safe.
That's right. So I just want to share that with you, because a lot of our clients who have these types of things set up, they go many, many years and they never followed the formalities. And it isn't until they come to our firm that they then learn about it. And fortunately, we have a solution for our clients that we actually can help them during this administrative term, that is prior to someone passing, that we can help to make sure that they're compliant with. This is part of what we do here at Barth Calderon.
Sweet. Very valuable.
Yeah.
Well, I'll tell you, this is valuable information, and the reason why I wanted to bring her today is so I can pass this on to my clients and ask my clients to please contact me so we can get them in touch with you, or have them contact you directly. And because I want my clients, we're building up cash value in their life insurance, and we just want to make sure that they're as protected as they can be. Especially in California.
Yeah. And I'll just kind of conclude with this one last comment. And because asset protection is just part of the comprehensive financial plan. That's all I want to say. Because as you're working towards accumulating money and savings and retirement and this and that, now that you have these assets, you want to make sure they're protected. You want them there to create the legacy that you work so hard for. And so you need to add that component of asset protection to the financial plan. So no financial plan is complete without considering the liability exposure that those assets have. All right.
I totally agree.
Yep.
Yep. And that's why I'm so glad I'm working with you.
Okay, great.
All right. Well, thank you so much. I really appreciate your expertise and spending these few minutes with me. And hopefully we'll get my clients well protected.
Great. Well, Gary, I appreciate the opportunity. Nice talking with you.
Yes, sir.
Okay, bye-bye.